Okay, time to bring on board another management voice. We have Tourism Finance Corp to chat with us about the impact of the growing hotel industry and the business outlook for FY20. Mr. B.M. Gupta, whole-time director, is with us. Mr. Gupta, welcome on board and a very good afternoon to you. First up, India is among one of the fastest growing economies. The hotel industry is expected to see a very, very robust growth. Given that you are a financier in this space, how are you reading into the developments and the growth projection from here on?
Outlook is very positive. We are quite upbeat on this. This year is bound to be 19-20, and another 2-3 years are bound to be very good in terms of hotel financing. And we see a lot of opportunities emerging in this sector. In fact, in the last 4-5 years, the new investment in hotels have not taken place. The result is that as on date, most of the metropolitan towns are recording average occupancy of more than 75% in the hotel sectors, and which necessitates creation of additional room capacities in these places. So I expect that in this year and in subsequent years, the new investment in hotels will pick up.
Could you give us a sense of what the disbursements and what the loan growth has been, and what are you seeing in FY20 as well? This year is an exceptional year so far as the financial system is concerned. This was a very challenging year, and particularly after September. So we had also not gone on aggressive expansion, but in next year we are looking for a growth of about 30-35%. Maybe my TFCI might look in terms of disbursements about 1,000 crore during the next 19-20. So, but we are yet to finalize the numbers. It's too early to say. But definitely we will look for a growth of about 30-35% in our loan book during the next year. And in light of the entire liquidity crisis in the NBFC space, and also the elevated funding costs being a big issue, what is your outlook on margins and borrowing costs for the new one, FY20?
So far as FY19 is concerned, we have been able to contain the cost because we did not raise funds from the market so heavily. We were already quite liquid in the beginning of the year, and then additional funds, whatever was needed, we had taken from the banks at a lower rate. So our cost has not increased to that an extent. But yes, going forward, the cost of borrowings for NBFC is definitely on the higher side. But looking to the robust growth in terms of demand for new products, for capital investment, I think we will be able to pass on the cost also to the new clients. And yes, definitely the cost of borrowings initially will be a little more, but we will give some options to the borrowers that after about 3-4 years or 5 years in case.
Mr. Gupta, for the benefit of your shareholders, if you could share some plans going forward, how are you planning to improve your ROEs from the current levels?
See, ROE is basically a function of leverage. TFCI has been maintaining a very good, very healthy capital adequacy ratio. As against 15%, we are somewhere around 37-38% as on date. And I need not raise any additional equity for next 3-4 years. Now, by raising the debt from the market and expanding my operations, automatically the ROE, return on equity, will go up. So we will try to leverage on the existing capital, and with the flow back of profits, it will be a continuous process for another 3-4 years, and for next 5 years, by next around 3 years, we will have definitely ROE of around 18% plus. So this is what our target is.
All right, Mr. Gupta, thank you so much for chatting with us and helping us understand what the projections for growth are looking like for Tourism Finance Corp in the new fiscal.